Okay, to keep going with chapter 4, let's go back to the big picture. Um, in this scenario, Emily's transferring her $2 million of property to Transformation for 200 shares of stock. Ethan transfers $48 million of cash for 4,800 shares of stock. In the same transaction, David will transfer, David's the employee, property worth $800,000 with the basis of $260, and then will serve as the manager of the corporation. And those services are worth $200,000 in exchange for 100 shares of stock. So it says here, Emily, Ethan's, and David's transfers qualifies under Section 351, so not taxed on the transfer. However, because you remember David's working as a manager now for a year in exchange for the $200,000, that would be services rendered, so there's a tax consequence for David then. For Transformation has a basis of $260 in the property acquired from David, and then would also have compensation expense as they pay David to be the manager of the business. His stocks basis is $460, which is $260 of the property plus the $200,000 income on the services. And then a little bit of a switch up here. Assume the same facts as in the previous example, except that David provides legal services instead of management services to organize the corporation. The same value, $200,000 for David, no gain in the transfer of the property, but again, still has income received. For Transformation, the basis is $260 and must capitalize the $200 as organizational expenditure, so basically debit asset. And then his stock basis is $460. So just FYI. Then holding period for capital assets of Section 1231 property. The holding period includes holding period for property transfer to the corporation. For other property begins 1 day after the exchange, so 1 day after. Then recapture considerations in the Section 351 transfer where no gain is recognized. The depreciation recapture rules don't apply. Recapture potential associated with the property carries over to the corporation. Now, capital contributions, no gain or loss is recognized by the corporation on receipt of money or property in exchange for stock. This also applies to additional voluntary pro rata contributions of money or property contribution, even though no additional shares are realized or issued. I'm sorry. And then how about contributions of non-shareholders? If property is contributed by to a corporation by a civic group, a government entity, to locate in a particular community, you'll hear of that every so often, that the city will donate land or something to a corporation in exchange for the business moving there and maybe getting some tax abatements or some tax deals and so on. Such contributions are included in the corporation's gross income. Okay, under the law in effect on and before December 22, those were excludable, but now they're includable. However, a municipality grants a tax abatement to a corporation for locating. The abatement is not considered a contribution to capital, or is it taxable? So it's if property is donated, typically land or something like that, maybe a building. For contributions in aid of construction by a non-shareholder, the corporation also recognizes the income on that. Okay, if property is transferred to a corp by a non-shareholder in exchange for goods or services, then of course, then that would be income. You're just basically, instead of accepting cash, you're accepting some property in exchange for goods or services. Then debt versus equity. On the debt side, the corporation pays interest to debt holder, deductible by the corporation. Interest is paid as ordinary, is taxable as ordinary income to individual corporate recipient. Loan repayments are not taxable to investors unless repayment exceeds the basis. And for equity, the corporation pays dividends, which are not deductible, taxable to individuals at lower capital gain rates to the extent the corporation has E&P, which is earnings and profits, which is essentially your retained earnings. Corporate shareholder may receive dividends receive deduction, right, if it's a corporation. And then talk a little bit about thinly capitalized corporations. If it has too much debt and too little equity, the IRS may argue the debt is really equity, denied tax advantages of debt financing, potentially. So that might come up in some scenario. If that's the case, debt instrument documentation would be needed. Debt terms what reasonable rate of interest and a definite maturity date would there be, the timeliness of the repayment of debt, and whether the repayments are contingent on earnings. And subordination of debt to other liabilities, whether debt and stock holdings are proportionate. The use of funds and the debt to equity ratio would come into play with those. If stocks and bonds are capital assets, losses from worthlessness are also capital losses. So if your stock is not worth anything anymore, loss is treated as occurring the last day of the tax year. No loss for mere decline in value. If stocks and bonds are not capital assets, losses from worthlessness are ordinary income. And then business versus non-business bad debts. General rule that losses on debt of corporation treated as business or non-business bad debt. If non-corporate person lends as investment, loss is non-business bad debt. If the corporation's a lender, the loss is business bad debt. Clearly that makes sense, right? We're a lender and we just had somebody that couldn't pay us back. It's a little bit different story then. If it's a non-corporate lender, you may qualify for business bad debt treatment if the loan is made in some capacity that qualifies as a trade or business, or the shareholder is in the business of lending money or buying or promoting and selling corporations. Okay, I'm going to stop right there. The rest of this is not covered hardly at all in the homework, so just FYI. So I'm not going to cover that as much, so just FYI. I should go back to the big picture though. So it says here, if Emily decides to retain $50,000 of cash basis accounts receivable rather than transferring them to the newly formed corporation, she would then recognize $50,000 worth of ordinary income upon their collection. Alternatively, if the receivables are transferred to transformation, the new corporation, as the facts suggest, the corporation will recognize ordinary income. Okay. Emily and Ethan, the sole property transfers must acquire at least 80% of stock issued by transformation. Otherwise, a tremendous amount of gain would be recognized. Even if Section 351 is available, any corporate debt issued by the corporation would be treated as boot and would trigger gain recognition. Therefore, you have to be very careful in how you go about doing that. And then a little bit of what ifs. What if the 351 transaction may be modified to further reduce personal and business tax costs, both at the time of formation and in future years? You have to consider what the strategies may be. So just look at the possibilities if we know something might change going down the road. And what if an additional benefit results if Emily does not transfer the cash basis receivables? This approach avoids tax at the corporate level and a further tax on the receipts are distributed to Emily. And then what if no mention is made as to the existence of any accounts payable outstanding at the time of the corporate formation? If they do exist, which is likely, it could be wise for Emily to transfer them to transformation. And that's it. As always, if you have questions, just let me know.